there, and welcome to Mr. Voice Talks. In today's video, we're diving into a fascinating topic, how gold prices vary and how they are fixed. Whether you're curious about what drives the ups and downs of this precious metal, or you want to understand the factors behind its pricing, you've come to the right place. Gold is one of the most valuable assets in the world. But have you ever wondered why its price keeps changing? Why does gold cost more during some years and less during others? In this video, we'll break down the main reasons why gold prices vary, explain how they are set globally, and provide some real-world examples so you can better understand what influences gold's value. By the end, you'll have a clear picture of what makes gold such a unique and powerful asset. Let's get started. This video is divided into two sections. Section 1 tells about factors that affect gold prices, and Section 2 tells about how gold prices are fixed. Now we go into Section 1, factors that affect gold prices. In this section, we saw about supply and demand, global economic conditions, central bank policies, inflation, and currency fluctuations. First, I explain about supply and demand. Gold's price, like any other commodity, is driven by supply and demand. On the supply side, gold is mined from the earth, but it's not unlimited. Each year, only a certain amount is extracted, so there's a fixed supply. On the demand side, people around the world buy gold for different reasons. For example, in countries like India and China, gold is a huge part of cultural celebrations like weddings and festivals, so demand spikes during those times. Apart from jewelry, gold is also bought by investors in the form of gold bars, coins, or even gold-backed exchange-traded funds, ETFs. Investors see gold as a store of value, especially during uncertain times. Lastly, industries like electronics and medicine use gold in their products, creating another layer of demand. When demand outpaces supply, prices rise. But if mining increases or demand falls, prices can drop. Then I explain about global economic conditions. Gold is often called a safe haven asset. But what does that mean? During economic crises or uncertain times, people turn to gold because it doesn't lose value like stocks or currencies. For instance, in 2008, when the global financial system faced a meltdown, stock markets crashed, but gold prices surged by over 25%. People used gold to protect their wealth. The same thing happened during the COVID-19 pandemic. When economies slowed down, gold prices hit all-time highs because everyone wanted the security it provided. On the other hand, when the economy is doing well and stock markets are booming, investors might sell their gold to invest in higher return options, reduces demand, and prices can fall. Stay concentrate, friends. Then we saw about central bank policies. Did you know central banks hold large reserves of gold? Institutions like the U.S. Federal Reserve or the Reserve Bank of India buy and sell gold as part of their financial strategies. If a central bank buys more gold, demand increases and prices go up. If they sell, prices drop. Central banks also influence gold indirectly through monetary policies. For example, when interest rates rise, gold becomes less attractive because people prefer to invest in assets like bonds that give regular returns. But when interest rates are low, gold becomes more appealing, driving up its price. Lastly, we saw the last topic of Section 1, inflation and currency fluctuations. Gold is also a great hedge against inflation. When inflation rises, the value of paper money decreases, but gold holds its purchasing power. For example, in 2022, when inflation in the U.S. hit record highs, gold prices rose as people used it to protect their wealth. Gold is priced in U.S. dollars globally, so changes in currency value also impact its price. When the dollar weakens, gold becomes cheaper for buyers using other currencies, increasing demand and driving prices up. But when the dollar strengthens, gold becomes more expensive for global buyers and demand can drop. Now we on into Section 2, how gold prices are set. This section tells about London Bullion Market Association, spot price, futures market. First, we saw about London Bullion Market Association. Gold pricing isn't arbitrary. One of the most important mechanisms for setting gold prices is the London Bullion Market Association, or LBMA. Twice a day, big financial institutions meet to agree on a standardized gold price called the gold fixing price. This serves as a benchmark for global trading. Whether it's jewelers in India or gold traders in the US, everyone uses this price as a reference point. Next, we saw about spot price. Gold also has a spot price, which is the real-time trading price in the market. Unlike the fixed price set by the LBMA, the spot price changes constantly throughout the day. This is because it's influenced by live demand and supply, along with global events. For instance, during the Russia-Ukraine conflict in 2022, investors feared instability, and gold's spot price surged to over $2,000 per ounce in just a few weeks. At last, we saw about futures market. Gold prices are also influenced by the futures market. Futures contracts are agreements where buyers and sellers agree on a gold price for a future date. These contracts are based on predictions about the economy, inflation, and global events. If traders believe gold will be more valuable next year, they start buying now, which pushes today's prices up. The futures market adds another layer of complexity to gold pricing. Now we come to the end of this video. Let's look at what's happening right now. Gold prices are fluctuating because of two main reasons: ongoing inflation concerns and central banks keeping interest rates high. Higher interest rates usually lower gold's appeal because investors prefer earning returns on bonds or savings accounts. However, geopolitical uncertainties, like tensions in the Middle East, are keeping gold demand steady. This tug of war creates constant changes in the price. To sum it up, the price of gold is shaped by supply and demand, global economic conditions, central bank policies, and market forces like the LBMA and futures contracts. Real-world events like financial crises, inflation, and geopolitical tensions play a huge role in influencing its value. So the next time you see gold prices change, you'll know exactly why. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share it with others. And tell me in the comments, do you think gold is the best way to protect your wealth in today's economy? I'd love to hear your thoughts.